Unit 6. Using relevant applications in practice, posting of the most common events in a company. In this part, we will examine the relevant practices in the posting of business events using practical examples. The practical examples provide a clear and easy understanding of the process of registering business changes in the company. In order to present the relevant practices in the posting of business changes, each posting contains an explanation that gives the reader an additional insight into the matter. After reading this unit, you will be able to read and solve practical examples related to the posting of business changes. Introduction. Every company in Cyprus should keep its accounting books according to the rule of double-entry bookkeeping. The proper posting of data must meet the following criteria. It is based on an appropriate document. It relates to the company. Data are entered in a continuous sequence without leaving a free space. No possibility to delete and change the original text and the amount. Posting of data immediately upon the occurrence of a business event, depending on the time of arrival of a document for bookkeeping. Respecting the principle of an unchangeable record. Below presented some examples of posting different business events based on the most important economic categories. Intangible assets. The most common examples of intangible assets are computer software, publishing rights, development expenditures, brands, expertise, know-how, goodwill, patents, licenses, concessions, trademarks and similar rights, franchises, licenses, marketing rights, design. If we accept one of many definitions of intangible assets that defines it as being non-physical, intangible, and which can be identified, it cannot be expected that a person who has not gone deeper into the analysis or is not professionally involved in financial accounting activities can understand what can and should be deemed as an intangible asset. From the accounting aspect, intangible assets are defined by the IAS 38 intangible assets. This standard requires the ability to identify assets and control them. The identification of an intangible asset implies its authenticity, which results from the possibility of separate sales, transfer, licensing, leasing or exchange. Also, the control over the means implies the possibility of realizing the future economic benefit that needs to flow from the use of the means. Intangible assets can be internally developed within the company, but according to the provisions of the above-mentioned standards, the research phase and the development phase need to be distinguished. The expenses incurred in the research phase cannot be capitalized, attributed to the value of the intangible asset, but should be treated as costs incurred in a specific period. In the development phase, in order to attribute the costs incurred to the assets, the technical feasibility of the intangible asset to be completed must be proven, so that it is available for use or sale, the intent of the entity to complete the intangible asset, the availability of appropriate sources for the completion of the development phase, the possibility of the use or sale of assets, the possibility of reliable measurement of the costs incurred and which are attributed to the intangible assets during the development. Intangible assets may have limited and unlimited useful life. In the case of limited useful life, the asset is amortized. Unlimited useful life implies the inability to estimate the time frame when the entity will receive cash inflows from using the asset and the asset will not be amortized. A very common example in practice is the acquisition of computer software. Example 1. On the 14th of October 2018 Company A acquired a computer software license from Company B at the price of €2,000 plus 19% VAT. In accounting books of Company A, the following entry will be done on the 14th of October 2018. Dr. Computer Software €2,000, to recognize the asset in company accounts. Dr. VAT input €360, to recognize relevant VAT input. CR creditor Company B €2,360, to recognize the liability to pay for the computer software. Example 2. On the 21st of October 2018 Company A acquired a set of 25 trademarks from Company D for a total price of €50,000. In accounting books of the Company A the following entry will be done on the 21st of October 2018. Dr. Trademarks €50,000. CR creditor company D 50,000 euros. II. Tangible assets. Tangible assets are physical, measurable resources, like property, plant, and equipment, used in a company's operations to produce profit. These assets include anything with a physical nature that is used within the company. Tangible assets can be divided into two main categories, current and fixed. Current assets are assets that will be consumed in the current period, within 1 year, like inventory. Fixed assets are long-term assets that will provide value for future periods to come. Some examples include machinery, vehicles, and buildings. Tangible assets can be damaged, repaired, stolen, and purchased because they are real items that get used in the normal course of business. Management must ensure these resources are guarded and maintained properly in order to preserve their usefulness. Tangible assets can also be used as collateral for loans. All tangible assets are reported on the balance sheet at their historical cost, but some have special reporting requirements. Long-term fixed assets must be depreciated over their useful lives with the accumulated depreciation reported on the front of the balance sheet. The plant and equipment are not initially intended for sale in the ordinary course of business, but this item of property may be sold due to obsolescence, replacement with a new one, etc. The assets can be sold at a higher or lower price than the book value, therefore, both examples are given. Example 1. On the 15th of October 2018, Company A concluded a contract with Company KM for the acquisition of immovable property with the selling price of 450,000 euros. The contract provides that Company A should settle its liability to Company KM within 6 months. For this purpose, Company A obtained a loan from the bank equal to 450,000 euros on the 21st of November 2018 and bank transferred the borrowed funds directly to Company KM the same date. In accounting books of Company A on the 15th of October 2018, the following entry will be posted. Dr. PPE 450,000 euros, recognizing of acquisition of property. CR Company KM 450,000 euros, recognizing of obligation to pay to Company KM. On the 21st of November 2018, the following entry will be done. Dr. Company KM 450,000 euros, settlement of liability towards Company KM. CR Bank Loan 450,000 euros, recognition of loan liability. Example 2. The property was sold at a lower price than the book value. Property of Company A was acquired at 300,000 euros 2 years ago. It was amortized at the rate of 4% per annum. Its accumulated depreciation currently is equal to 24,000 euros, therefore, its book value is 276,000 euros. This property was sold to Company PLG on the 23rd of October 2018 for 250,000 euros. Upon acquisition of the property, the following entry was made in accounts of Company A. Dr. PPE 300,000 euros. CR creditor 300,000 euros. At the end of the first year, the depreciation of 12,000 euros was posted as Dr. Depreciation Expense, PL, 12,000 euros. CR accumulated depreciation, BS, 12,000 euros. The same entry was done at the end of a second year. On the 23rd of October 2018, Company A sold this property and made the following entry in its accounts. Dr. Debtor Company PLG 250,000 euros. Dr. Accumulated Depreciation 24,000 euros. CR PPE 300,000 euros. Dr. Loss on sale of PPE 26,000 euros. Example 3. The property was sold at a higher price than the book value. If we take the previous example but change the selling price to 450,000 euros, entries for the acquisition of PPE and its depreciation will be the same as in the example above. On the 23rd of October 2018, Company A sold this property and made the following entry in its accounts. Dr. Debtor Company PLG €450,000. Dr. Accumulated Depreciation €24,000. CR PPE €300,000. CR Gain on Sale of PPE €174,000. IV. Current assets. A current asset, also called a short-term asset, is a resource expected to be used to benefit a company within a year or the current accounting period. The most common current assets are cash, accounts receivable, inventory, and prepaid expenses. These are all resources that a company can use in the current period to purchase new assets, pay debts and expenses, or convert into cash. Examples of current assets include cash and cash equivalents, accounts receivable, inventory, short-term investments, loans receivable within 1 year, prepaid expenses, for example, insurance premiums that have not yet expired, marketable securities, cash and cash equivalents. During its operation, a company will need to open a bank account in order to receive funds from customers and to settle its liability towards suppliers, or for obtaining finance from the bank or its shareholders. Upon incorporation, shareholder of the company transferred to the bank account of the company €10,000 for shares of the company, representing share capital. The following entry will be done upon issue of shares to shareholders. Dr. Shareholders Current Account €10,000. CR Share Capital €10,000. Upon shareholders' settlement of its liability. Dr. Bank Account €10. CR Shareholders Current Account €10,000. Claims. Trade receivables are claims against buyers and others for money, goods or services. For the purposes of financial statements, receivables are classified as short-term or long-term. Short-term trade receivables are those that are expected to be collected within 1 year or during the current business cycle, depending on which period is longer. All other receivables are classified as long-term. Receivables are further divided into trade and non-trade receivables. Trade receivables are amounts owed by buyers for goods sold or delivered services as part of normal business activities. Trade receivables, usually the most significant of the company's assets, may be further classified as receivables from buyers and debentures. Non-trade receivables may arise from various business events, and can be written promises of both payment and delivery. Some examples of such claims are advances to officials and employees, advances to the auto company, deposits to cover potential damages and losses, deposits serving as a guarantee of performance or payment, claims on dividends and interest, etc. Example: a company sold provided legal services to its customer AG for €45,000. The receivable from AG was not received yet. The following entry will be done. Dr. Debtor AG. €45,000. CR Provision of legal services €45. V. Goods, Retail. Recording of business events related to retail merchandise in the main book includes 1. Calculation and recording of goods in the main book accounts. 2. Recognition of revenue from sales of goods and VAT recording. 3. Deleveraging of a shop for sold goods and recording of the purchase costs of sold goods. It is necessary to recognize sales revenue, item 7603, at the selling price of goods and to recognize expenses, item 710, at the purchase price of the goods sold. The calculation of the purchase value of the goods sold at the expense of the period, item 710, is done by calculating the VAT rate of the goods sold. For example, a 25% tax rate calculation is 20%. After that, we need to calculate the amount of margins in the merchandise, using the formula for the average margin of the store that can be calculated in the following way. Image 2, Average margin. 6,681 store margin account. 663 goods account at the store. Source: directly with stroke, purchase and sale of goods in retail trade, accounting, audit and finances. Zagreb, October 2012. VI. Liabilities. A liability is a debt owed from one company to a person or company that is not an owner of business. In other words, liabilities are debts owed to non-owners or creditors. They are classified as short-term if it is expected to be settled in the regular business cycle. It is due to be settled within 12 months after the balance sheet date. It is primarily held for trading. The entrepreneur has no unconditional right to postpone the obligation settlement for at least 12 months after the balance sheet date. When obligations do not meet the above criteria, we classify them as long-term obligations. The example of recording of long-term obligations. The Company A obtained a loan from Company B in the amount of €250,000 that should be repaid in 5 years' time. The funds have been credited to the bank account of Company A. The following entry will be done. Dr. Bank account €250,000. CR loan payable €250,000. VI. Capital. Capital refers to the financial resources that businesses can use to fund their operations like cash, machinery, equipment and other resources. These are the assets that allow the business to produce a product or service to sell to customers. There are three types of equity, i.e. own capital, owner's capital, partnership capital and share capital. Owner's capital is that owned by one person. The owner has unlimited liability for the debts of his company with his entire property, business and personal. Capital owned by partnership companies is partnership capital. Although this type of capital is identical in terms of characteristics, it is possible that some owners have limited liability in the amount of business assets, limited liability partnership. The third type of capital is share, corporative, capital. This capital is divided into shares and has a high degree of capital market mobility. The liability of its owners is limited to the amount of business property. It's important to distinguish money from capital because they aren't the same thing. Capital is more durable than money and is used to produce something and build wealth. Property rights give capital its value and allow it to generate revenues and build wealth. Equipment, machinery, patents, trademarks, brand names, buildings, and land are a few examples. Capital is defined as one's own source of financing of assets and is calculated as the remaining assets of an enterprise after deduction of all its liabilities, and it consists of subscribed capital, capital reserves, revaluation reserves, fair value reserves, revenue reserves, retained earnings or loss carry over, and profit or loss for the current year. An example of recording in the general ledger. Upon incorporation of a Company A, shareholder P transferred €10,000 to the company's cash register, shareholder F transferred equipment on €15,000, and shareholder K transferred shares of other company with the value of €35,000. The following entry will be done. Dr. Cash €10,000. Dr. Equipment €15,000. Dr. Investment €35,000. CR share capital €60,000. A responsible accountant should commit to providing all his services in good faith, in accordance with the rules of the profession and conscientiously. Unfortunately, if the accountant's responsibilities are not contractually defined, it will be difficult to prove his sole responsibility for the omissions. Every bookkeeper must continuously improve his skills and knowledge, stick to the legal regulations and the ethics code. It is good to subscribe to relevant publications so that the person is always informed on changes to legislation. On the other hand, the business organization management is interested in the financial position of the company and its profitability. For this reason, the management aims to get the financial statements as often and as quick as possible so it can take actions to repair areas with poor results. Investors will be particularly interested in the annual financial statements because they are the reports used by decision makers outside the company. For example, if creditors see the balance at the end of the year as strong, they will be more willing to give credit to the company than if the financial position of the company is weak.